Hey friends, we are halfway through the year 2025, and that means two things. One, we are actually closer to the year 2050 than we are the year 2000. I know, it's a little depressing. And two, we've got some mid-year stock market news to talk about it. So today, we are going over 9 random stocks that are crushing the S&P 500. We'll talk about PE ratio, we're going to talk about PEG ratio, we're going to talk about how big are these companies, also known as market capitalization, and then we're looking at earnings per share to help you make the best decisions possible.
Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. Let's get into it.
First up, a company that I don't invest in, but I kind of wish I did, but I don't because I think they're a little sleazy. I think they're spying on American citizens. And sure, maybe you shouldn't say that on a YouTube video, but that is the only reason I haven't invested in Palantir. Because Palantir's been on my radar for at least 3 years. I was looking at Palantir when they were $19 per share, but I looked into some of the contracts they have and I wasn't really comfortable investing in Palantir because of their government work, specifically with spy agencies. I personally don't invest in any company that has to do with war, at least directly with war. Like General Dynamics, I'm out. Boeing, I'm out. In Palantir, in this instance, I'm out. However, a lot of you have invested in Palantir, ticker symbol PLTR, and they are up 97% midway here through July. I know, it's crazy. 97% halfway through the year. Seems like my morality is getting in the way of my money making, but hey, you got to do what you got to do. I think most people who invest in Palantir don't necessarily fully know what Palantir does, but what Palantir says they do is develop AI technologies to help you break down huge amounts of data to make the best decisions possible. Let's talk about the metrics. So Palantir has a market cap of $335 billion. They're no longer just a little player in the data analytics space. They are a major player in the data analytics space. But PE ratio, the price to earnings ratio, this tells you how much you have to pay for every dollar of earnings of a company has. Palantir, 617. Yeah, that means you have to pay $617 for every $1 of future revenue. Palantir had better deliver on revenue. The PEG ratio for Palantir is 4.38. With such a high PE, it's not surprising to see a high PEG. This indicates that the price is quite high relative to its initial earnings growth. And then speaking of earnings, let's look at EPS, 0.23. Not exactly the kind of numbers you're looking for. If you're a value investor, the higher, the better on EPS. For reference, Google is 8.97 EPS. Next up, we have NRG Energy. NRG Energy, if you don't know, ticker symbol NRG, provides wholesale energy, they provide retail energy, and they provide energy to commercial clients. NRG's market cap is $31 billion. And this places them firmly in the large cap territory. Their PE ratio is approximately 25.22, a bit higher than the broader market average, so you need to be a little careful here. Their PEG ratio is roughly 1.34. You often want to see a PEG under 1 is going to show you that it's probably an undervalued company. Anything over 1, especially getting into the 2s, you're thinking this could be a little bit overvalued. However, earnings per share for NRG is 6.35, so that's a pretty good number to be looking at. Let's go to stock number 3. And I lied to you. It's not really stock number 3. It's tied for number 2 on the list. This is the comeback kid where some people left for dead. We're talking about Super Micro, SMCI. Early last year, maybe it's even early this year, they were talking about an accounting scandal. People were thinking this stock might be left for dead. Hindenburg did a hit piece on them and they were shorting the company. And they did. They fell a lot. If you were an early investor in SMCI maybe last year, you felt the pain. However, SMCI is making a big comeback. This year to date, they're up 77%. SMCI's market cap is $31.7 billion. They have a PE ratio of 27.4. Again, this is indicative of a company of high demand sector. Their PEG ratio is 1.63. Their earnings per share is only 1.81, so it's not like super great there either. All right, let's go to the 4th stock. Number 4 on the list, Seagate Technologies. You might be like, Seagate? That sounds familiar. It probably is. Seagate was the first external storage drive I ever had. I thought this thing was awesome, even though it was super massive. Seagate Technologies is up 72% year to date. And why is Seagate Technologies pumping? Well, if you're in the data space and you're not just doing small external hard drives, but you're doing large database center places, you're making some money. Their market cap is about $30 billion. Their PE ratio is 18.78, so that's pretty moderate compared to a lot of the other industry. Their PEG ratio is only 0.19. So when you've got a PEG ratio that low, you're looking at possibly a very undervalued stock, even though they're up 72%. The earnings per share of 6.92 is nothing to shake a fist at either. Seagate might be worth looking into. The next stock on the list is Howmet Aerospace, HWM, and they're up 67% year to date. Howmet Aerospace is a global leader in engineered metal products and solutions, primarily for aerospace and defense industries. Their market cap is $74.4 billion. Their PE ratio, not as big as Palantir's, but still pretty big, 60.04. The PEG ratio, 2.63, so we're getting definitely away from that like value play. This is definitely a high growth potential, and their earnings per share is about 3.07. Next on the list, we get GE Vernova. Now GE, that's the part you're probably familiar with, General Electric, but Vernova completely spun off from GE. This is now its own separate company, and this year they're up 65%. What do? They spun off from GE. They focus on power generation and renewable energy technologies. They're a key player in energy transition, providing turbines, grid solutions, and nuclear tech. Their market cap is approximately $56 billion. Their PE ratio, however, watch out, is about 75. Similar to Palantir, their PEG ratio is over 4.15, so that's pretty high. You're definitely not looking at a value play. And their earnings per share is 7, which is good, but you got to think that's a pretty overvalued company. Maybe just something to keep on your watch list. Next, we're looking at some miners. Newmont Corporation, ticker symbol NEM. They're up 49% year to date. Newmont is the world's leading gold, copper producer, as well as silver, zinc, and lead. They operate mines from North and South America, Africa, and Australia. Their market cap is around $67 billion. Their PE ratio is pretty good, actually. It's under the average of the S&P 500, which is about 17. The PE ratio for this company is only 12.67. So you could be looking for some value, but let's look at the PEG ratio. The PEG ratio, 0.99. So it is under 1, so you are looking at potentially a value play. And the earnings per share, 4.46. I'm gonna put this one on my watch list. Who said cigarettes are dead? Philip Morris is coming in next, up 49% year to date. Philip Morris, known for cigarettes. Now they're trying to make a big push into the vape and the heated nicotine market. In fact, I was scouring the website, and they are really trying to get away from original tobacco products, at least at face value. The website is pushing vape, the website's pushing heated cigarettes, but they're still making a lot of money on regular homegrown rolled tobacco. The market cap for Philip Morris is $281 billion. They're a very large, very established company. The PE ratio for Philip Morris is 37. Despite being a traditional industry, that PE is pretty high. The PEG ratio is way overvalued at 3.22. The earnings per share, not as high as you would like to see for a company that seems to be this overvalued. It's only 4.87. Listen, the Trump tariffs haven't been good for everybody. In fact, they've been pretty bad for most people. I think they're a terrible idea. But it seems like people are flocking away from Target and they're going into Dollar General. Dollar General's up 45% year to date. If you don't know, Dollar General is a kind of a quirky little store. If you live in rural America, you've probably seen a Dollar General on every other corner. If you live in a larger city, you may not even know Dollar General exists. Dollar General's market cap is $25 billion. They have a PE ratio of 21.6, a PEG ratio of 2.76. That far over 1 could indicate this puppy has already hit its peak, so be careful of that. Earnings per share for Dollar General, 5.24, so that's good, but be careful, they could be overvalued here. And finally, rounding out the list, this was a surprise for me. In fact, I had to Google. I thought this company was bankrupt. Their biggest competitor did file for bankruptcy, Walgreens, but we're talking about CVS. And CVS is up 44% year to date. And possibly it could be because, well, their biggest competitor is filing for bankruptcy, and maybe more people are going to CVS to pick up the slack, or maybe people just like the huge receipts.
I've been fighting for common sense issues for my entire adult life, and at the top of my list, my number one issue is this: these insanely long receipts they give you at CVS.
So what does CVS do? They're a diversified healthcare company. Obviously, they've got a store on every corner in a large city. They also bought Aetna Healthcare. So they're getting into not only the provider space of like medical products and beauty products, but they're also actually doing insurance. The market cap for CVS is around 82 billion. The PE ratio is right in line at 15.2. They got a PEG ratio, also right in line, 1.08. And CVS earnings per share is 4.19. So not bad for a possibly undervalued company, but they are up 40-something%. So take a look, put it on your watch list, and you make the decision. Don't overpay, don't chase returns. However, some of these stocks have perked my interest. I'm gonna take a look and put a few on my watch list. Picking individual stocks could be hard. It's like finding a needle in a haystack. But these are 9 pretty random companies that are way outpacing the S&P 500, which I think is around 4.5% positive year to date. So yes, passive index investing is great. Yes, that is how a lot, if not most of my portfolio is in, but I do like looking for individual stocks because stuff like Palantir, stuff like CVS, Dollar General, all over 40%, some up to 97%. It feels really good when you find a stock and it's up over 50%. So do your own research, stay classy. We'll see you next week.
Thanks for joining me today on 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.